Preparing for FP&A at Genpact interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. What is FP&A, and how does it support business decision-making? FP&A connects financial performance with business decisions. I would explain that the function builds budgets, updates forecasts, analyzes variances, and translates results into recommendations for management. Strong FP&A professionals do more than report historical numbers. They identify drivers, challenge assumptions, and highlight risks and opportunities. For example, if margins decline, I would separate pricing, volume, mix, and cost effects before recommending actions. The role ultimately improves resource allocation, accountability, and forward-looking decision-making. While answering, focus on planning, forecasting, performance reporting, management insight, business partnering, cash awareness, and how FP&A converts financial data into actionable operating decisions. Question 2. Walk me through your approach to preparing an annual budget. I begin by reviewing prior year actuals, current performance, strategic priorities, and known contractual or market changes. Then I build assumptions for revenue, staffing, compensation, operating costs, capital expenditure, and cash flow with the relevant business owners. I document those drivers, test the model, and perform reasonableness checks before consolidating submissions. After management review, I incorporate approved changes, finalize targets, and establish monthly reporting against the budget so ownership remains clear throughout the year. Make sure to cover historical analysis, business drivers, stakeholder inputs, assumptions, headcount, operating expenses, capital spending, review cycles, consolidation, challenge, approval, and budget governance. Question 3. What is the difference between a budget, a forecast, and a plan? A plan describes the organization's strategic direction and intended actions, often across several years. A budget converts near-term priorities into an approved financial baseline, usually for one fiscal year, and supports accountability. A forecast is the latest estimate of expected performance using current information, so it can change during the year. I compare actuals with the budget to assess accountability, while comparing results with the forecast to understand whether our latest outlook remains achievable. In your answer, distinguish purpose, timing, flexibility, strategic intent, baseline accountability, latest expectations, and how each tool is used together in management reporting. Question 4. How would you build a rolling forecast? I would establish a consistent horizon, such as the next 12 months, and refresh it monthly or quarterly. Each cycle, I replace the oldest forecast period with actual results and add a new future period. I update operational drivers including volumes, pricing, utilization, hiring, attrition, and vendor costs rather than simply applying growth percentages. I would review assumptions with stakeholders, document changes, and compare forecast accuracy over time to improve the process. Be sure to mention forecast horizon, monthly updates, actual replacement, operational drivers, assumption ownership, scenario review, variance feedback, and avoiding mechanical extrapolation. Question 5. How do you perform a meaningful variance analysis? I start by identifying material variances against both budget and the latest forecast. Then I decompose the movement into operational drivers such as volume, price, mix, productivity, timing, foreign exchange, or one-time items. I validate the explanation with the business owner instead of relying only on ledger descriptions. Finally, I quantify the full-year impact, assign an owner, and recommend an action. A useful variance analysis explains what happened, why it happened, and what changes next. Focus on materiality, actual versus budget and forecast comparisons, root causes, volume, price, mix, timing, one-time items, ownership, corrective action, and clear communication. Question 6. How do you determine whether a variance is favorable or unfavorable? Favorable or unfavorable depends on the effect on the relevant business objective, not merely whether a number is higher or lower. Lower expenses are generally favorable, while lower revenue is unfavorable, but context matters. A hiring delay may create favorable salary variance today while damaging future revenue capacity. I would also distinguish timing from permanent savings and investigate whether a favorable result reflects sustainable improvement. My conclusion would explain both the accounting impact and the operational consequence. Make sure to cover financial impact, business context, revenue and expense direction, quality of earnings, timing, reversals, and why favorable does not always mean positive performance. Question 7. How would you forecast revenue for a service-based business? For a service business, I would build revenue from operational drivers rather than a single growth assumption. Those drivers could include contracted work, client volumes, billing rates, utilization, delivery capacity, renewals, attrition, and expected project start dates. I would separate committed revenue from pipeline and apply realistic probability weights to opportunities. I would also model seasonality and currency effects, then compare actual conversion and billing performance with prior assumptions to improve forecast reliability. In your answer, discuss contracts, pipeline, client volumes, pricing, utilization, capacity, renewals, attrition, foreign exchange, seasonality, and probability-weighted opportunities. Question 8. What is driver-based planning, and why is it useful? Driver-based planning links financial outcomes to the operational factors that create them. For example, payroll can be modeled using headcount, average compensation, hiring dates, and attrition, while delivery revenue may depend on volume, price, and utilization. This approach makes assumptions transparent, supports sensitivity analysis, and allows faster reforecasting when business conditions change. It also improves accountability because operational leaders can directly influence the drivers underlying their financial targets. Cover causal operating metrics, transparency, scalability, sensitivity analysis, accountability, faster updates, cross-functional alignment, and examples such as headcount, volume, price, utilization, and cost per unit. Question 9. When would you use zero-based budgeting instead of incremental budgeting? Incremental budgeting starts with the existing baseline and adjusts for expected changes, making it efficient for stable operations. Zero-based budgeting rebuilds spending from the ground up and requires each activity to be justified. I would consider it when costs have become embedded, priorities have changed, or management needs a significant efficiency reset. However, applying it everywhere can be disruptive. I would target discretionary, duplicated, or rapidly growing cost categories while protecting critical capabilities and service quality. Discuss reset assumptions, cost discipline, baseline limitations, time and effort, strategic reprioritization, essential versus discretionary spending, and selective application to suitable cost categories. Question 10. How would you create a best case, base case, and downside scenario? I would identify the assumptions with the greatest financial sensitivity, such as revenue volume, pricing, client retention, hiring pace, utilization, or foreign exchange. The base case would reflect the most supportable outlook, while the upside and downside cases would change specific drivers with documented rationale. I would quantify impacts on revenue, margin, cash flow, and capacity, then define trigger points and management actions. This makes scenarios useful for decisions rather than merely presenting three numbers. Be sure to mention key assumptions, independent variables, probability, sensitivity, operational actions, liquidity, triggers, decision usefulness, and avoiding arbitrary percentage adjustments. Question 11. What would you do if a department consistently missed its budget? I would first determine whether the misses reflect poor execution, unrealistic assumptions, timing, accounting classification, or changes in business conditions. I would analyze recurring patterns and meet the department leader with evidence rather than blame. Together, we would identify corrective actions, such as approval controls, hiring changes, vendor renegotiation, or a revised operating plan. If the original budget is no longer realistic, I would update the forecast while preserving the budget as an accountability reference. Focus on fact-finding, recurring versus one-time drivers, forecast bias, operational ownership, constructive challenge, corrective actions, reforecasting, and escalation based on materiality. Question 12. How do you incorporate working capital and cash flow into FP&A? FP&A should connect the income statement with cash generation. I would forecast collections using billing schedules, payment terms, aging, and customer behavior, while modeling supplier payments, payroll, taxes, capital spending, and financing needs. I would reconcile operating profit to cash flow by considering working capital movements such as receivables, payables, accruals, and deferred revenue. If liquidity tightens, I would highlight the drivers early and recommend collection actions, spending controls, or revised payment timing. In your answer, cover profit to cash conversion, receivables, payables, billing timing, collections, accruals, deferred revenue, cash forecasting, and actions that protect liquidity. Question 13. How would you forecast headcount and employee costs? I would begin with opening headcount by function, location, grade, and cost center. Then I would model approved hires using expected start dates, planned attrition, promotions, salary increases, bonuses, benefits, and contractor costs. I would distinguish funded positions from speculative requirements and reconcile the model to the HR roster and payroll actuals. Finally, I would test the impact on capacity, revenue delivery, utilization, and margin because headcount is both a cost and an operating capability. Make sure to cover opening headcount, approved requisitions, hiring dates, attrition, promotions, compensation, bonuses, benefits, vacancies, utilization, and reconciliation to HR data. Question 14. Which KPIs would you monitor in an FP&A role at Genpact? At Genpact, I would tailor KPIs to the service line and management objective. Core measures could include revenue growth, gross and operating margin, utilization, productivity, headcount, attrition, bookings, backlog, client retention, cash conversion, and forecast accuracy. I would connect financial outcomes to operational indicators, such as whether lower margin reflects pricing, delivery efficiency, or staffing. The dashboard should emphasize trends, exceptions, and actions rather than overwhelm leaders with disconnected metrics. Discuss revenue growth, margin, utilization, productivity, headcount, attrition, bookings, backlog, client concentration, cash conversion, forecast accuracy, and tailoring KPIs to business and client context. Question 15. How would you use Excel, Power BI, or planning systems in FP&A? I use Excel for flexible modeling, scenario analysis, and controlled calculations, while Power BI is valuable for automated dashboards, trends, and drill-down reporting. Planning systems improve workflow, version control, and submission discipline across business units. Regardless of the tool, I focus on clean source data, standardized definitions, documented assumptions, and reconciliation to the general ledger. Automation should reduce manual effort and errors, but I still apply judgment to interpret movements and challenge the outputs. Mention model structure, data validation, automation, dashboards, drill-down capability, controls, version management, system integration, and keeping tools aligned with business questions. Question 16. What would you do if actual data from different systems did not reconcile? I would not immediately adjust the forecast to force a match. I would define the exact difference, confirm period, entity, currency, and account scope, and trace each source back to the ledger or operational system. Common causes include timing, mapping, duplicates, missing entries, or different KPI definitions. I would document the root cause, quantify materiality, correct the source or transformation, and establish a repeatable reconciliation control before distributing management reporting. Be sure to cover data ownership, period and entity scope, mapping, definitions, cutoffs, duplicate records, reconciliation controls, materiality, documentation, and escalation. Question 17. How do you partner with non-finance stakeholders who resist the budget process? I would first understand why the process feels burdensome or unhelpful to the stakeholder. Then I would explain how accurate assumptions support resource requests, staffing decisions, and performance visibility, using operational language rather than finance terminology. I would simplify templates, provide clear deadlines and examples, and challenge assumptions respectfully with evidence. My goal is partnership, not policing. Once stakeholders see that FP&A helps them make better decisions, data quality and engagement usually improve. Focus on listening, translating finance into operational language, explaining value, simplifying templates, respecting accountability, using evidence, negotiating assumptions, and maintaining constructive challenge. Question 18. Describe a time you improved forecast accuracy or reporting efficiency. In one reporting process, the forecast relied on manually consolidated spreadsheets and produced inconsistent assumptions across teams. I standardized the template, defined driver ownership, added validation checks, and introduced a monthly review of forecast to actual errors. That reduced consolidation time and made recurring bias visible, allowing managers to correct assumptions earlier. The main lesson was that accuracy improves when process discipline, clear definitions, and operational accountability accompany technical automation rather than replacing them. Use a structured example covering the initial problem, diagnosis, intervention, tools or controls, measurable result, stakeholder adoption, and lesson applied to future planning cycles. Question 19. How would you evaluate a business case for a new project or client opportunity? I would clarify the strategic objective and build a model linking volume, pricing, staffing, implementation costs, ongoing operating expenses, and working capital. I would assess contribution margin, break-even timing, cash requirements, and returns under base, upside, and downside cases. I would challenge revenue conversion and cost assumptions, identify contractual or execution risks, and define approval thresholds. After launch, I would compare actual performance with the business case so lessons improve future investment decisions. Cover strategic fit, revenue assumptions, implementation costs, staffing, pricing, margin, cash flow, risks, sensitivity analysis, break-even, return measures, and post-investment performance tracking. Question 20. Why do you want to join Genpact in an FP&A role? Genpact appeals to me because it combines global operations, process transformation, analytics, and strong client focus. In FP&A, I could contribute by making budgets and forecasts more driver-based, improving reporting discipline, and translating performance data into actions for business leaders. I also value the opportunity to work across functions and geographies, where consistent processes and clear communication matter. My goal would be to provide reliable numbers, thoughtful challenge, and insights that improve profitable growth. Mention Genpact's global scale, process orientation, analytics, transformation mindset, client-focused operations, cross-functional exposure, continuous improvement, and how your FP&A skills would create practical business value. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.